Today's webinar could save you thousands of dollars. Like many of you, I am a real estate investor. In May of this year, I sold an apartment complex. A few of the investors were at a stage in their lives that they wanted to take their profits instead of exchange into another deal. So I started looking for an opportunity zone investment to invest my profit. Even though I knew about opportunity zones since they first started in 2018, this was the first time I considered investing in one. I quickly realized two things. First, if I did not invest in an opportunity zone deal by December 31 of this year, I would miss out on one of the main benefits of the opportunity zone investment. And second, opportunity zones are complicated and I needed help from a professional who really understood them before I could make an intelligent decision about whether to invest and in which deal. That's when I was fortunate enough to meet my guest, opportunity zone expert that you're going to hear from today. Welcome to Opportunity Zones. You're about to lose one of the biggest benefits of opportunity zones. Here's what you need to know now. Since I'm an attorney, I have to give you an important disclaimer that this is an educational presentation only. Today's speakers are not offering you legal or other professional advice, and they have no attorney-client relationship with you solely by your receipt of this information. Any actions with regard to the information contained in this seminar should be undertaken only upon the advice and counsel of competent legal, tax, and estate planning professionals. Some quick housekeeping. First, don't talk to us. We can't hear you. This is a webinar, not a meeting. And as far as questions, we will give you the opportunity to ask questions. What you should do is put your questions not in the chat, but put them in the Q&A. We'll only be looking at the Q&A. And we'll save the questions till the end just because there's a lot of content that we want to cover. We'll make sure we have time to do that. For those of you who do not know me, I'm Jeff Lerman. I am a featured commentator on TV, radio, and newspapers. I'm past president of the Marin County Bar Association. I'm an unusual lawyer. I'm the real estate investor's lawyer, and I'm also a real estate investor. We focus on helping investors with their transactions, litigation, and estate planning. I've been rated AV highest award by Martindale-Hubbell. I'm chair of the California Bar Real Estate Litigation Section, chair of the Marin County Bar Real Property Section. I've been general counsel for 2 real estate syndication companies. I've been doing this for 40 years. Again, I'm a real estate investor. I'm also a real estate broker, although I just broker my own deals. I don't broker for other people. And our website is realestateinvestorlaw.com. My guest speaker today is Andrew Gradman. And Andrew received his BA from Stanford University, his JD from Columbia Law School, and his LLM in taxation in 2016 from NYU Law School, and business certificate from NYU Stern School of Business. He also plays cello in the Los Angeles Lawyers Philharmonic, so he has other interests. His website is below, gradmantax.com, and his phone number is right there, 310-710-6636. Welcome, Andrew. It's good to have you here. What you will know by the end of today's talk is the following. What is the Qualified Opportunity Zone program? What are the tax benefits? How does it compare to similar tax reduction arrangements? If a taxpayer is considering investing in a QOZ, what are the steps? If the taxpayer is a business seeking investments from qualified opportunity zone investors, what are the steps? What are some industries that work really well with qualified opportunity zones? What are some pitfalls that should be avoided? What's the catch? Is it too late for me to invest in an opportunity zone deal? How do I go about finding the quote right opportunity zone deal for me? How much will it cost me if I miss the December 31, 2021 deadline? What other options do I have to benefit from opportunity zones if I miss the December 31 deadline? What are the unique risks posed by opportunity zone deals? And please stay till the end. We have a special gift for you, which we will explain later. And with that, I'm going to hand it over to you, Andrew, to walk us through each of these points and educate us.
Terrific. Thank you for that introduction. So I've been doing qualified opportunity zones since the program started. which was with the Tax Cuts and Jobs Act in 2017. I saw it in the bill and I said, it would be nice to have a thing of my own, since I'm a young lawyer about to go out of my own practice. And it's since been more than 50% of my practice ever since. I've seen a huge variety of cases, of clients, and I've spoken with a lot of people who are actors, in DC and here in California, and have a really I think a really unique set of experiences, which I hope to compress for you today. What is this program? Qualified Opportunity Zone program is in the context of a lot of other similar programs that are hoping to take private capital to improve the circumstances of the underserved, new markets tax credit, low income housing tax credit, other features of that kind. A new book just came out by David Wessel, giving the history of the Qualified Opportunity Zone program, which gives the story. Sean Parker of Napster fame had this vision, and it came to fruition in the Tax Cuts and Jobs Act. It was successful. The scheme of it is that in all of these programs, you have a carrot and a stick, right? The carrot is you can get tax benefits if you do some things, and the stick is going to be we're going to take them away if you abuse the program. And that lines up with the structure of the program. The investors get all the carrots, and the qualified opportunity funds get all the sticks. So the idea is we create these entities called qualified opportunity funds. It's just a partnership or a corporation. That you could think of it that way for now. And it must do business in a qualified opportunity zone, which are designated areas you can get on the internet by searching for them. And typically that means you typically own real property and develop it in the zone. And if you become a qualified opportunity fund, I want to start by dispelling a common myth. There are no benefits to you. It's not like becoming a 501c3 nonprofit where you become a tax-free and all your income is not taxed, and it's really nice to be a 501c3. To be a qualified opportunity fund, it's purely a burden. You have to meet certain requirements, and if you fail them, you incur a penalty. But you do this because of, well, the one benefit is you can solicit investment from investors who are seeking to invest in a fund such as yours in order to be able to get the carrot, which is the tax benefits that the investors get. What are those? The sequence of events is the investor cannot get any benefits unless they first recognize a capital gain. This is currently, a lot of people find this to be frustrating, and there's maybe thoughts that this could be revised in the future. But to understand the theory behind this, the QOZ theory was, let's incentivize people to shift out of traditional blue chip assets and into underserved assets. And so they wanted to make sure that would happen by limiting it to people who, say, sold their stocks and bonds and capital gains and whatnot. So that's a prerequisite. And then within 180 days of either the date of the sale or what I'll call simply the deemed date of the sale, because it can be constructively moved around a bit, that person needs to write a check to an entity that is a qualified opportunity fund. Once you write that check, you have done everything, assuming that entity will actually qualify as a fund, which is simple. They check the box in the form. They've done everything they have to do. Just one more myth to dispel, though. Clients then say, oh, I get all the tax benefits if I do that? And I say, yes. And they say, okay. But the myth is, if you're not done yet, because QOZs are not just purely about the tax benefits. It's about the quantity of those benefits are proportionate to the economic success of the investment. So, that fund that you invest in, you want it to do economically well, because the better it does, let's talk about the benefits, right? The main benefit number one is you had this prior gain that you had before investing, that'll get deferred until 2026. So you get effectively an interest-free loan. Do the math on that. What's the value of that loan? Well, the opportunity cost, that loan would be paid. If you didn't pay the tax to the IRS, you would owe, I guess, penalties as well as the underpayment rate. So it's not a huge opportunity cost. We're talking, let's call it 2% to make it simple. You get an interest-free loan at 2% savings until 2026. Another benefit is that the thing you invest in, so you're going to pay that tax in 2026. But now let's go fast forward 10 years from today. if you sell your qualified opportunity fund investment at any point thereafter, it will be that remainder, any appreciation, as well as any depreciation from depreciation of the assets will not be taxed. So that is the potential huge benefit. You want to get that asset to really appreciate or depreciate for tax purposes to maximize your economic benefit. And then the third benefit, taxpayer Benny, is that if you invest your funds by December 31st of 2021, which is 7 weeks from now, you can also get a 10% haircut on the tax you would otherwise have to pay, triggered in December 31st, 2026, payable in 2027. So, you'd have to do the math to see what we're talking about here. I once did a calculation on the phone with Jeff where we assumed a $400,000 gain, and we came to a $10,000 savings. More gain, more savings. But always consider opportunity costs, and are you going to rush a decision merely to get that benefit? It's something every taxpayer has to consider. So that I've just rushed through. Before I proceed, Jeff, do you want to jump in with a question, or should I?
No, I think I had a couple thoughts, but we'll cover those at the end. Keep going. Okay,
so covered the taxpayer benefits. I want to convey that the taxpayer benefits are going to be, I've said they're proportionate to the economic success at the fund level. They're also proportionate to the compliance with the rules at the fund level, because what's the stick that the fund suffers from if it doesn't comply? So here is the essence of the program. The fund files Form 8996 with its partnership return or corporate return every year. And it is asked to disclose, effectively to describe its balance sheet at 2 points during that year. Let's say June 30th and December 31st of each year. Then you average that together, and then you look at that and you ask, what percent of the assets on the balance sheet are qualified opportunity zone property? The test is, if more than 90% of the assets are qualified opportunity zone property, you're fine. And if it's less than 90%, then you pay a penalty, the fund pays a penalty, in proportion to the deficit that it fails to meet that standard. Of course, I'll define qualified opportunity zone property momentarily, but you get the gist of it. It's the kind of property that you want to have in a low income investment. And so that's a carrot that's borne by the QO, a stick, excuse me, that's borne by the QO fund entity, but the investor owns that entity. And if the entity has to pay that penalty year over year, the investor is losing out. He's going to suffer too. So you definitely are sensitive. So when the client asks, have I qualified for all the tax benefits when I write my check to the QO fund, it's a bit misleading for me. And I don't merely say yes, because obviously your results may vary depending on what transpires over the next 10 years. And that's an important point to be aware of. I've noticed, I see sort of three classes of, and I realize this audience may contain people of varying levels of familiarity with this program. I want to accommodate the people who have learned some before. I want to make sure I give out some cool tidbits. Don't worry, you're gonna get some tricks and cheat codes. Also, I think of it in terms of the investor audience and the developer audience, because so they each have different sets of concerns. The developer audience is people who are considering creating a fund to attract investment from people who otherwise are looking for funds, for QO funds to invest in. As I've indicated, that would be the only reason to qualify to be a fund. I know it sounds appealing when you're like, oh, I own land in a qualified opportunity zone area, and I can make it a QO fund. This is so great, I should do it. Well, only do that if it's worth your while to attract investment from people who are seeking investments in funds, because you might be able to complete your syndication without doing that and without having to take on the potential stick of the 90% compliance test, which comes with being a fund. So, and it's interesting because when I represent those developers and funds themselves, there is no market for people looking to invest in funds. You know, you want to get on the phone, you want to find people who've sold their property 180 days earlier, have a capital gain. Where are you going to find those people? I find that if a company is already a development company or a real estate company and they have lots of people invested in lots of projects, they can internally make a phone call and say, hey, we've just sold a property for a gain. I know you have a gain because I sold the property for you. Would you like to invest in my other project? And that's a very ideal symbiotic relationship. But if you're just off the cuff going to set up a fund, it's really hard to find people who have the gain within 180 days. That's a very common obstacle to even setting up the fund. I represent people on both sides. I find that there's a dynamic, like a spectrum in this area between the very sophisticated, polished, I call it sort of Midtown Manhattan, 40th story and up fund offering, where, you know, there's some big DC name on it and all they want is to take your check. But the other end of the spectrum, there's what I call the mom and pop, which is a substantial part of my practice. People who are already developers, professionals, they know how to build a building and they just want me to bless something that they're going to do and add tax benefits to it. And then in the middle, there's this very difficult, I find those two opposite ends of the spectrum are very easy because there's no negotiation over the terms of the deal.
Do you know if crowdfunding is getting into the opportunity zone market or not really?
I don't know if it is. I don't know if it is. As long as you could get over the qualified investor hurdles, then I don't see why it couldn't. But I've not been introduced to any deals of that kind.
Right. Okay.
Yeah. So what I find is interesting is the qualified opportunity zone statute. It's badly written and badly conceived, like everything in the Tax Cuts and Jobs Act. I mean, I still advocate that people take the tax benefits that are available. I mean, I represent people and help them do it, but I just mean it was a very rushed program. And so there's all sorts of glitches and discontinuities and things of that nature. And these things don't come to your attention usually at these opposite ends of the spectrum where you're representing big institutional clients or mom and pop, because on those ends of the spectrum, there isn't any negotiation going on. The institutional client says, here's the deal, take it or leave it. And mom and pop don't care what the deal is because they trust one another and their family. But in these mid-size or small-size deals, which are arm's length, you start to discover these discontinuities become a problem because you are advocating for your client, whether it's the investor or the fund, and you see really interesting problems. So Jeff, one problem I may have chatted with you about is what I call the moral hazard problem, the problem of incentivizing your manager to do the right thing. In a traditional investment, it's easy. You just throw more money at your manager and the more money, incentivize, in proportion to profit. And then that seems to work. You give them 2 and 20 and call it a day. But in a QO fund, the manager may not share that incentive. If they don't invest their own qualified capital, then they're not looking at the same incentives as the public investor because they don't care about the 10-year horizon. And even if they do invest qualified capital, you can under the statute, under the regs, you can't convert a profits interest that is earned for services into a qualifying interest. So those hurdles that are profits interests for that manager won't be qualified, even if they invested qualified capital. So we have the situation where there's a disconnect in incentives where the manager will generally be willing to sell the property before the 10-year horizon or at a sooner date than the investors may wish. So you want to create some kind of management structure in the operating agreement that accommodates that. And I think that there are 3 ways to handle that. One is to say, you take a hike, which is what what most institutional funds do. They say, look, we could sell this at any time, and we're not going to negotiate with you because if you don't invest, someone else will. That's a legit method. Another method is to allow some kind of a veto power in the hands of the in the hands of qualified investors. So say they get to decide when the sale occurs. And that's often what I do. Even when I represent managers, I think that they tell me that they're okay with my voluntarily adding that to the agreement and giving their investors that power because they perceive that it would give comfort to their investors. And the third option is to try and get the manager to invest as much qualified capital as possible and organically have his incentives aligned. But as I've indicated, that only goes so far because it won't apply to the profits hurdles.
Well, I think from the developer standpoint, the last thing I'd want to do is give that kind of power to my investors. It's even though I understand it's an option.
Yeah.
For any of you out there who are developers, I would not want to do that, but I get it. It could help you get investors that otherwise you might not get. But
yeah, so if you're the developer, you don't want me representing the the investor because because I fear that. When QOZs first came out in 2018, I'm blanking on the name of the first PPM which I saw, which is good because I'm about to make them look stupid. But a client shared the materials with me, and I picked out this, and I called their person, like their CEO, and I said, hey, I raised this issue with him. He said, oh, this isn't a problem at all. We would never do such a thing as that. And I said, well, that belongs in the PPM. Like this, you have to say that. And so suddenly there was an update to the PPM. And they updated and said, we can sell this at any time. And there's a risk you'll lose your QOZ benefits. And it was a small victory, even though it was kind of a loss.
Yeah.
So these are just some of these things that only emerge, some of these sort of problems that only emerge when you're representing the middle market. Another, I realize I'm kind of meandering. Is this okay that I'm just sort of talking off the top of my head?
Well, why don't you tell us, because since we did identify the topics that would be covered, because I was looking at it and I'm not 100% clear which bullet point you're on right now. So you tell me.
I'm just talking. What's the QOZ program? What are the tax benefits? We've done that. How does it compare to similar tax reduction arrangements? Let's talk about that quickly. Part of the popularity for the QOZ program is that we've never had anything like it before. In the olden days, someone would go to their CPA and they'd say, I just sold a building. What do I do? And the CPA would say, you're going to pay tax. And that would be the end. Now that happens, there's a thing that the CPA can say. And to the client, it's like, oh, that's a thing. Maybe I should do it. The only other things you could do in that specific circumstance is make a charitable deduction. And that, or people also do this immediately before the sale. They do charitable lead trusts or charitable remainder trusts. And, despite the word charitable in the name, this is not my specialty, but I've spoken with people who have indicated to me that you could get a pretty fabulous result from a charitable lead or remainder trust if you plan it correctly,
right.
Where the assets grow tax-free. And so due to that tax-free deferral, you could make potentially more money than you put in. That's stuff for an actuary. I don't know how that works.
That is something that our estate planning department does frequently. So that's an important point to bring out as a good alternative.
As a good alternative, good, okay. And I do want clients to think about that, and to understand that the word charitable and charitable remainder trust, you are helping a charity, but mostly the loser is the government, and you and the charity both make off pretty well. If a taxpayer is considering investing in a QOZ, what are the steps? Let me speak to the investor's perspective and sort of tell the story again with more detail. The first thing is, I would always want to know, what's your basis in the asset being sold? I always ask that question, and people are always like, why do you ask that? It's relevant because California doesn't comply with this program. And I'm assuming I'm speaking to a California audience, but I could be speaking to any audience that pays a high tax rate and is in a state that does not conform to the program.
We actually have participants from around the country. So, but
okay.
Anyway, go ahead.
I haven't memorized which states conform or don't.
That's okay. That's okay.
So I apologize to all of 49.
Okay. Just focus on California, but I'm glad you clarified that this is just for California.
I have to clarify because it's so frightening when I fail to clarify and then the client finds out after a little time's gone by. So what's your California rate? Your maximum marginal rate can be as high as 13.3%. That's on incomes over $1 million. And the program doesn't defer that income or do anything to that. So you have to pay that tax. So then what this means is, I always say that qualified opportunity zone program creates a liquidity challenge for the investor. And that's because the benefit, when you invest $1, when you write $1 as a check to the federal government as tax, you pay $1 of tax. But when you pay $1 of tax into a QO fund, it's effectively like a temporary deduction, not a credit. And so by deducting or excluding $1 of capital gains tax, you only defer 20 cents worth of tax, assuming a 20% rate. So to soak up a full $1 of federal tax, you have to pay $5, in contrast to writing $1 check to the feds as a tax payment.
And so I just want to interject something here. So since on this particular bullet point is what are the steps if you're considering investing in a qualified opportunity zone deal? In addition to everything that you're saying, I will tell you for us people who don't know everything that you know, you need a team on this. You need to have a CPA who understands opportunity zones and also understands whatever deal you're coming out of, so that you can get some sort of a realistic idea of what how much you will. I mean, one of the first things I had to do is actually ask. I had two CPAs. I had a CPA that was I was using for my apartment complex, and I have my personal CPA, and I had to work with both of them. And the first thing was, tell me how much I have to invest. How much is of all of this is going to be capital gains that will make me, so I could understand what I'm talking about. But the other thing you need is a guy like Andrew, who is a tax attorney who really understands opportunity zones, because that itself is a really important topic that a lot of CPAs may not really be as familiar with as somebody who spends as much time on it as Andrew does. Those are, I think, and the other thing is, if you have a wealth manager, then you want to talk to your wealth manager, because what I did is I called my wealth manager and I said, here's what I'm thinking of doing. If I didn't do this and I gave the money to you, how would you invest it? And what do you think, what do you estimate the profit would be if I took this amount of money and put it into whatever investment you would put it in? And at a minimum, I think you need those 3 conversations to really, and by the way, also an estate planning attorney to talk about the alternatives. It's a very complicated, it really blows me away. I've been doing this for 40 years, and the level of complication in this particular strategy is pretty significant. And so I really want to emphasize the importance of having a good team before you make a decision.
I really appreciate that point. I think I could have stepped back and sort of said that the first steps are not steps you take. It's thoughts you have, it's conversations you have, it's reflections you have. Right. You know, I just had this thought while you were speaking. You know, the QOZ program isn't primarily a tax program. It's like a marketing program. They really went out of their way, in ways that I may or may not describe in this presentation, to make it like they're selling something to you. I mean, with the you know, benefits if you invest by 2019 and then 2021, all sorts of gimmicks are in there which don't exist anywhere else in the tax code. It's like they're trying to sell something to the public. And one of the core, I think philosophically, the way this happened was they wanted, at the heart of this, they're trying to take people who are investing in traditional conservative assets like stocks and say, we'd love it if you would invest in impoverished communities and do things you wouldn't normally invest in. And that sounds all well and good until you pause and say, well, that's changing human nature. There's a reason physicians don't develop real properties. It's because they only have the time to study the prospectuses of stocks. And so this whole program is woven through with things that go against human nature. I get a lot of calls from people who have fallen for congressional marketing. This is Congress doing this, and think this is a simple program. This is like the new markets tax credit program. If you know what that is, you know that's one of the most complicated things in the world. People just don't roll out of bed and say, I'm going to invest in a new markets tax credit investment. This is that complicated.
Right. And,
so,
and the additional thing that apropos what you just said about being counterintuitive is all of a sudden you're looking at deals that by definition are in an area, in a location that up until then have been not really considered as a good place to invest. And so what you need to do is really understand that particular deal. And if it's a fund that has multiple deals, that may be more complicated. And if it's not a fund and it's just one particular deal, then you just really need to get a comfort level about that. You have to, which can be difficult, but that does make it more complicated. Again, not trying to discourage you from this, but I'm just trying to highlight the things that are involved in the process.
So I'll jump to the question, I'm being so disloyal to our agenda. How do I go about finding the right opportunity zone deal for me?
Okay.
So I'm gonna do both sides of this. So what you just mentioned, when you read prospectuses, I saw this the first time in Urban Catalyst's prospectus, and then I think everyone plagiarized. There's this language that says, you should invest in an asset which does not correlate to the performance of the stock market in order to diversify your holdings. And so it's a nice point to make, except that the point is that these assets don't correlate with the stock market because the stock market goes up and these, assets typically go down. So it's a euphemistic point to make. But the best funds that I see take a very broad geographic scope. They're not like, hey, let's go find, I live in LA, let's find something in LA. If that's your attitude, you're already starting off with a handicap. You should find a fund or an opportunity to be able to take a purview of all 50 states, because the way you do this is, the arbitrage here is that they did not designate the zones well. They designated a lot of zones which are upwardly mobile, which are already economically successful. In David Wessel's book, he tells the story about a conference on QO funds in Las Vegas, in a fancy Vegas hotel on the Strip. And someone just comments, hey, did you know that we're currently in an opportunity zone? And someone says, that's ridiculous. We're in this lavish hotel. Well, it turns out they were in an opportunity zone. And there's a lot of opportunities like that around the country. It's very subtle, I think. What I think is the art of good QO fund management are people who really understand real estate well. Not they understand development, but they understand how to identify up and coming areas. They understand that kind of statistical stuff. And that's what the good funds are doing. That's the advantage of pursuing a good fund that you understand is doing this, is that they are seeking these arbitrages in the rule, which are really there. And that's how you do it. Well,
as long as you bring up that point, how, there are, I'm looking at a couple deals that I talked to you about it. And it does, how does somebody, I'm looking at a deal that is with another wealth manager. A lot of wealth managers now are doing their opportunity zone deals. Bernstein and a lot of others are doing it as well. So is there any way that you can suggest that somebody can look at those deals and evaluate how successful the operator, the developer is, other than just saying, show me your track record? And which, by the way, when it comes to track record, if you say, show me your track record on opportunity zones, forget about it, because opportunity zones, a lot of these haven't even been built yet, because it started in 2018 and it takes a while to actually get things approved and whatnot. So what do you say?
Jeff, you may know this from knowing a handful of tax lawyers, but we tend to avoid answering questions of that kind. When a client asks me, I'll give you a gimmicky answer, but the truth is, I always say, I'm the tax guy. You, pointing at the client, are the economics guy. You've got to find an investment that's economically sound. I will say that an observation that we tax folks have about this program is that because that's the way it is, and because it's very opaque to answer that question, there's a lot of cult of personality type deals growing up, where they bring on a person whose name is prominent, And for better or worse, I'm not in a position to evaluate whether that's a
Right.
criticism or not, but it is hard, and that is a problem with this program. That's why when clients come to me and they are willing to do their own deal where they buy a building. So going to your question, which angle's better? We have clients, it's always the choice between, do you do it yourself or find one-off deals, or do you invest in a big fund with lots of deals? So each has their own advantages. The big fund, you have the advantage of truly professional management, which can do a nationwide search for properties. And if there's multiple funds, there are some accounting benefits that when money is released from one fund, it can be redeployed into another. Those are genuine benefits that they reap. When I have the clients come to me, I say, here's the advantages for you. I say, if you own your own fund, you're the manager, you get to call every shot. You know, there's no management fee being taken off the table. And in my personal opinion, the act of being a manager of a large QO fund is not different than the act of being a manager of a regular non-QO fund, but they are charging larger fees, and that's because that's how supply and demand works. If there's more money on the table, they're going to take some of it. So those fees, look, of course, you know, you're going to pay them. That's how it works. But there's arbitrage all over this program where money gets taken by people other than the low-income community or the client who seeks the tax benefits.
Right.
And so if you do your own fund, that's one concern that you don't have to worry about. I call it like hunting. You know, you hunt, if you want to have a hamburger, do you want to go to McDonald's? I mean, you know, every hamburger is the same. They're all standardized. You can trust them. You know what you're eating, but do you want to eat that? That's sort of, or do you want to sort of hunt your own?
Right. Should we go to the next bullet? If the taxpayer is a business seeking investments from investors, what are the steps, or is it?
Yeah, let's do this. We can do this concretely. So I'm going to assume that we're all talking real estate. I came across a statistic that 95% of QO funds have some real estate angle to it. So let's just start with that premise. So you want to find a property in a QO zone and want to have a plan for developing it that's going to meet the criteria. I'll tell you what those are. I'll just say it never happens that way. A client never calls me and says, let's start by developing a plan and then let's start soliciting investors. They've always called me after they've solicited investors. But here's what you need to do to get the tax criteria. You buy the property and then you double the basis of the non-land portion. That's your main obligation in this thing. So let's say you buy land for $1 million, a building and land for $1 million. We do an appraisal and we allocate values to the building and to the land. So let's say there's a revenue ruling where they use 40% of the building and 60% of the land. Mm-hmm. So now that means $400,000 of basis is in that building. Your obligation then is to create invoices, pay $400,000 worth of money that represent improvements to that property. It doesn't matter whether you actually improve the value of the property. You can put $400,000 worth of concrete into all the trinks and drains and toilets, and that will still meet the requirement, even though the property value goes down. But it is the invoices and the costs that you have to do. And then once you meet that, you've basically met your main requirement. Some points to make is that this is a cliff. This is one of the main problems, anxieties that one should face. You don't plan on spending $400,000 on a $400,000 building. Plan on spending $600,000, because if costs come in too short and you fall short and you spend $399.99, that one missing dollar will not get you partial credit in the IRS's eyes. So there are other obligations, but they're kind of like, there's a list of sin businesses you can't do. You can't do a massage parlor, a golf course, a store selling alcohol. You know, if you have one of those in mind, I'll tell you that. But you can do a cannabis property because that list of sin businesses was never updated since it was created in the 90s. Then all you do is you issue units to people for cash. And that is the basic answer to what a developer has to do to seek investment.
If you're looking for, if you want get investors for your business as opposed to a real estate deal, correct? Is that what you're saying?
What I've just described was a real estate deal.
Okay.
I'm sorry if I said otherwise.
So the next point, the taxpayer is a business seeking investments from OZ investors. What are the steps? So,
oh, okay. There's this jargon that I keep hearing where people contrast real estate with business, and I have never fallen in line with it, so I apologize for being vague. I mean a business of any kind, including real estate, and in all likelihood, real estate, because
okay, it's the same. Okay, so that's,
I meant it that way. Yeah.
okay. So, and this probably answers the next bullet point. What are some industries that work really well with opportunity zones? I think it's basically real estate. That's.
Yeah, I'd be happy to sort of explain that if it's worth the time, if it's okay.
Well, let's see.
All right, whatever you think.
Well, we're getting short, and so let's circle back if we have additional time, but I want to make sure we have time.
We cover the other points
at the end for questions. What are some pitfalls that should be avoided, and what's the catch?
So,
boy, the pitfalls, we could spend an hour talking about that.
Yeah, I'll just say really quickly, I have an article coming out in the next version of California Tax Lawyer, a little blurb, 1,000 words or something, arguing why people who want to do non-real estate businesses are going to be very sorely disappointed when they analyze the tax benefits 10 years from now. I'm not trying to do a backdoor way of answering the previous question, but one pitfall is I am not a fan of non-real estate businesses. I don't think they should be done. And I think in my peer group, it's like, oh, if you're a really good QOZ lawyer, then you do a software company. And I'm like, no, if you're really a good QOZ lawyer, then you don't do a software company. That's the next step above that. We could do a lot of pitfalls.
The top three biggest pitfalls.
Top three biggest pitfalls. People who invest without having had a prior gain or missed their 180-day deadline.
Sure.
People who do not create a 31-month plan. You've got to have a written plan. And I mean the business entity, the developer, has to have a somewhat detailed plan for the expenditure of their funds. Obviously, sophisticated investors do this, but mom and pops just sort of skip this step.
Well, let me interrupt you something on that last pitfall. So you say if they miss the 180-day deadline. In my situation, my 180-day deadline comes up on November 15, but for some reason under the statute, under the code, if I can miss the 180-day deadline, and as long as I invest before December 31 of this year, I don't have a problem, right? That's what we.
Yeah,
do.
It's pretty cryptic, right? So I'll do that. So I always say it's 180 days after the gain or after the date the statute deems the gain to have occurred. So
everybody, this is important. We're doing the best we can in 1 hour of time on a very complicated thing, but this is why you need to get a tax attorney who really understands this, because I would have never known that unless I spoke to Andrew. Yeah, in this case, it's not that clear cut. And so,
and I have people who are making their investments now because we're getting to the end of the year and they're aware of that 1231 10% thing that goes away. And in the back of their subconscious, they just assume, oh, it's all 2021 gains. No, if you make the investment in December, it's only gains going back to July.
Right.
And someone actually has to sit and go through, if like a stock, you got to have someone go through your 1099. And I've done this for a client, line by line, and identify the date. If it's crypto, like that's a lot of sales that you may have done. Right. And that has to be done line by line to determine your gains.
Right.
May I describe the situation you and I discussed briefly?
Sure.
So I've become kind of an unwilling expert on the art of extending people's deadlines to invest. And so even if there's 180 days, say from March to November, here's the thing. I always ask clients, did your gain arrive to you in the form of a K1, or will it arrive to you in a K1? That means partnership, S corporation, a trust of some kind, a certain kind? If the answer is yes, K1s get a special extension because Treasury in its wisdom decided that people don't generally know the underlying operations of their S corps, partnerships, and trusts. They only find out later. So the default rule is your 180 days are pushed later and start on December 31st of 2021, 180 days from there. Or you can elect to start it on March 15th, 2021, or in the case of a trust, it's March 30, 2021. Or you can elect to have it be the date of your sale, which is this year, May of this year, if that was the date of the sale. Crazy points, but the point are a few things to keep in mind. One is you only have to choose. You have to choose one of those periods. You don't get all of them. So if you make a QOZ election in June of this year, then you cannot then get the benefit of biting the apple a second time and make a QOZ election in February of next year, because those are mutually inconsistent 180-day periods. This is little known fact that people don't know. Big mistake. Always make this mistake. Shall we do another bullet?
Yeah. Let's see. Is it too late for me to invest in opportunity zone deal? Well, clearly it's not, but you expand on that.
So let's talk about a question people commonly ask is, how is this going to be affected by tax reform? And that's probably a place we can talk about. Right. So from the very beginning, the benefits of QOZ investment always declined with time. As I said to you, when I was an intern in Congress, I had a friend who took me aside and said, you need to understand that all these people are used car salesmen. And I thought he meant it as an insult, but really they actually legislate in the way a used car salesman would sell a car. It's like, buy it now or the deal will go away. They put this into the act. And you were familiar with that because of the tax benefit that goes away this year, as well as the fact that the deferral is till 2026, so that value declines with time. But the other thing that has occurred is that there's now consideration about raising tax rates in the future. So the capital I don't know what's going to happen. I have no idea what's going to happen, but there's a meaningful risk that the capital gains rate could go up in the future. And here's the thing: when you pay the deferred tax in 2026, or you write the check in 27, you pay it at the rate in effect on December 31st, 2026. You don't lock in today's rate. So you could pay the tax at a higher rate. So is it worth it to do this?
Right.
If you're going to get to 10% off, then it's probably worth it. I say probably because I don't know what the tax rate is going to be, but it's probably worth it. If you're not going to get the 10% off and you're going to make this investment in January or February of next year, then all you're getting is an interest-free loan where the opportunity cost of that interest-free loan is what I just made up, what I call it, 2%. So you're getting a 2% loan for free for 5 years. I don't know whether it's worth it if the tax rates are going to go up. That's a big risk. You could lose money on this.
Right. Yeah. Well, and to that point, this might be a good time to mention the thing that we were talking about right before we started this, in terms of I'll just go ahead and say it, that you shouldn't go into an opportunity zone deal just for the tax benefits if you don't think it's going to be a good deal without regard to the tax benefits. Do you want to speak to that?
Yeah, it's sort of in light of what we've spoken about. There's this, people commonly confuse this with a 1031 exchange, and they have this misperception that it's very
different from that.
It's not the same. You've got to do a lot of work. You've got to, or you have to. Your investment needs to lead to economic substantial investment, and risk is undertaken.
More risk, and there's a lot more risk with it. Yeah. Yeah.
The analogy to a 1031 exchange is unfortunate. And I do always tell people, when people call me and they say, oh, I can get a tax benefit, so I'm going to do this, I say, let's slow down. And you can tell from my tone on this call, I apologize if this is unwelcome, but I've learned over the years that when I speak about this program, it's very important to me to lead with all the negative stuff. Because if I don't do that, people get excited first, and then they learn the bad stuff later. And by that point, it's too late.
Right. And by the way, on that same point, if you want to talk about other alternatives, and this is not going to be a talk about Delaware statutory trusts, but that is worth mentioning because most Delaware statutory trust deals have about the same return on investment as most of the opportunity zone deals, somewhere in the single digits. But in those Delaware statutory trust deals, you usually know what the deal is going to be, and it's usually going to be in a great location, not a marginal location or a location that it looks like it may turn into something a lot better than it is today. So if you're considering your other options, put that one on, and if you're not sure what a Delaware statutory trust is, look it up, Google it, and there are people that's all they do.
May I ask, or would it be a fair analogy to say a Delaware statutory trust is like a blend between a 1031 and a REIT, where you do a 1031 and do a diversified? It's maybe that's oversimplification.
Yeah, I'm not sure I would.
You don't like it?
Yeah. Okay.
Sorry about that.
Let's see. So next, how do you find the right opportunity zone deal for me? Well, I have a thought, but you go.
Yeah, no, I think that tip I gave earlier about just being as cynical as you can be. Don't try to benefit anyone. Don't try to, I mean, you're doing this for yourself. Charity is something you can do on the side. You got to look for something in a really upscale area that's just been misclassified as a low income area, and then you're going to really do well. That's my contribution. What do you think?
Couple things. So first thing I did when I was looking for the quote right deal is there's actually a company here in the Bay Area that I work with, and they do opportunity zone deals. And so I talked to them. I talked to my wealth manager. The wealth managers always know opportunity zone sources. So I would talk to them. I would also, when we're talking about the right deal, I always want to know how much whoever is referring me to an opportunity zone deal, I always want to know how much they're getting paid for it. I want to know what they did in order to get comfortable that this was a deal that they should be showing to me. I also, when I have a deal, I like to take it to somebody else. There's this other company that I've been working with, and I showed them a couple of the pro formas from the deal. And I asked them what they thought of the numbers and this, that, and the other. And they brought up a couple of things that I had not even thought of looking at, and that were important. So again, it goes back to these deals. I mean, the average size of the pro forma or the package that you're going to get is hundreds of pages. The last one I looked at was 340 pages. It's impossible to understand and review that with the same level of understanding that you would do with a single deal. So you really need to, get good experts to help you on that.
And I know we're about to transition into questions. Can I throw out a point real quick?
Please go.
So one thing I've noticed, so I review PPMs, I've drafted PPMs on this. One thing is never disclosed in other people's memorandums is that when you invest in a QO fund, you don't have what we call outside basis, which is in your ownership interest. And that makes sense because you're investing money that you were never taxed on. I'll explain what that means in just a second. But what that means is in every other real estate investment you do. And so you expect that during the first few years, you'll be able to enjoy depreciation deductions and interest deductions. But under the QZ statute, they artificially set you down to zero unless you have basis from some other source. And so it's often a risk. People are investing in this real estate investment and think, I will get depreciation and interest deductions, even if they're going to be passive. No, you probably won't. What I mentioned this in the context because I review PPMs from like sophisticated providers, and they have a section that they copy pasted from their PPM from 10 years ago on deduction disallowance. And they don't mention that in there. And so I called my friend at Greenberg Glusker and I'm like, hey, like, what the hell? And he says, yeah, no one seems to mention that. They forget to mention that. It's crazy. You're going to go for your first, it's very likely that for your first 5 or 6 years in one of these ventures, and I mean a sophisticated, anyone, but particularly even a sophisticated Wall Street one, where you're expecting to get some passive losses out of this, and you will not. And it will not be, it may not even have been disclosed to you, because that's how crazy this terrain is.
Right.
Just wanted to throw out that random.
Yeah, appreciate it. And before I go into questions here, you do opportunity zones, but you also do all other real estate tax, whatever people might need in terms of their real estate investing, correct?
Yeah, I do everything. Everything is, I don't do litigation controversy audit, but I do everything planning related.
Right. So, whoops, that was not good. Hold on a second.
Testing.
Yep. There we go. So I said that if you wait till the end, we'll have a gift for you. And the gift is an ebook about advanced opportunity zones. And that is something that I believe, Andrew, you're going to send to everybody. And you'll do that in the next couple of days. Yes.
I'm afraid to talk now. Yes.
I know. I know.
Yes.
Should have done this before. It has the whole thing transcribed.
Happy to do it. Yes.
All right. So you'll be doing that. Okay. And so let me see if I can pull up the. Let me stop the share. That'll be the first thing I should do. Hold on a second. There we go. And let me look at the Q&A. Okay, actually, it looks like nobody really has any questions, huh? We thoroughly, oh, here we go. Here's one. Andy asks, how about if I use fresh capital? I guess what you mean, Andy, is if it's what, not capital gains or what? I'm not sure what you mean.
Well, I'll assume that, and I'm sure he'll clarify.
He says no capital gain. That's what he says.
Right. You can't do that. And it's something that people have been asking Congress to change this, because it excludes people who don't have gains from investing. I'll just explain why they do this, so you don't feel it's completely arbitrary. They wanted to incentivize people to exit their blue chip investments and move into QOZ properties, and so they limited it to people who sold and had a gain. That's the reason why you can't do that.
Got it. Okay. He also asks, after 10 years, can I sell tax-free?
Yeah, anytime between the 10th year and then between 2048. They put that 2048 in there to prevent you from becoming the next Rockefeller, and they're holding it for like 100 years. And then, and yes, you can sell tax-free subject to that tax that you had in 2026, yes.
Mm-hmm. And so, anybody else have any questions? I'm looking here and I'm not sure that I don't see any other questions at this point. So we've either thoroughly confused everybody and they give up, or they're just too afraid to ask questions. Not sure. In any event, if you decide you have a question after the fact, you can, how can they get in touch with you, Andrew?
Any of the contact information that is provided, my email and my website, www.gradmantax.com, has in it my email and phone number, and that's a good way.
Okay, and
if you reference this, that this is how you encountered me, I will not charge for the initial call.
Oh, that's very generous of you. Andy asked one final question to confirm: only if I had a capital gain, I can utilize qualified opportunity zones and sell tax-free after 10 years. Yes, I can answer that one. Yes, that you understand that correctly. Right. Okay, everybody, thank you very much. This is a very important topic, and it's one not to take lightly. So again, by all means, get your team together before you make any decision, and we will have a recording of this available. We'll send it to you as well in case you came late. Thank you very much for taking time out of your busy schedule, Andrew, and everybody that attended today. And we will look forward to seeing you at the next event.
Thank you.
Great, thank you.